Want to build wealth in today's world? These 10 financial strategies will set you up for long-term success. Don't miss out on the best tips every investor should know. Welcome to Crypto Finance. Number 1. Diversification. Diversification is a fundamental strategy for reducing risk in any investment portfolio. By spreading investments across different asset classes, stocks, bonds, real estate, etc., industries, and geographic regions, you mitigate the impact of a poor-performing investment. This approach helps prevent a significant loss when one sector or asset class underperforms. In the world of investing, diversification works like an insurance policy for your portfolio. While it doesn't guarantee profits, it balances risk and returns, ensuring your portfolio remains stable even during market downturns. However, it's important to maintain a thoughtful approach. Over-diversification can lead to mediocre returns. Striking the right balance is key. Over time, diversification helps smooth out volatility, providing a more predictable return on your investments. As a long-term strategy, diversification sets you up for financial growth, regardless of short-term market fluctuations. Diversify wisely and watch your wealth steadily grow. Number 2. Asset allocation. Asset allocation is the strategic distribution of your investments across various asset classes, such as stocks, bonds, and cash. The goal of asset allocation is to align your investments with your financial goals, risk tolerance, and time horizon. It's not just about how much you invest, but where you invest. By having a well-balanced portfolio, you reduce exposure to any single asset class and mitigate potential losses. Your allocation should change over time depending on your life stage and market conditions. Younger investors may lean towards stocks for growth, while those closer to retirement might prefer safer, income-generating investments like bonds. Regularly reassessing and adjusting your asset allocation is crucial to maintaining a portfolio that fits your evolving needs and objectives. A well-thought-out asset allocation ensures that you're on track to meet your financial goals, whether for short-term needs or long-term wealth building. Number 3. Dollar cost averaging. Dollar cost averaging, DCA, is a simple yet powerful investment strategy that involves regularly investing a fixed amount of money in a particular asset, regardless of its price. By investing consistently over time, you buy more units when prices are low and fewer units when prices are high, thus averaging out the cost of your investment. DCA removes the emotional aspect of investing, as it discourages timing the market, a common pitfall for many investors. It's particularly effective in volatile markets, as it reduces the risk of making a large investment at the wrong time. Over the long term, dollar cost averaging can result in a lower average cost per share, helping smooth out market fluctuations. Whether you're investing in stocks, mutual funds, or crypto, DCA provides a disciplined approach to investing and can be an excellent strategy for long-term financial growth, regardless of market conditions. Number 4. Risk management. Risk management is a crucial financial strategy that every investor should master. It involves identifying, assessing, and minimizing the potential risks in your investment portfolio. Understanding your personal risk tolerance is the first step in this process. Some investments are riskier than others, but by balancing your portfolio with a mix of high and low-risk assets, you can cushion the impact of market volatility. Diversifying your investments across various sectors, industries, and asset classes reduces the overall risk of your portfolio. Another key aspect of risk management is setting stop-loss orders, which automatically sell your assets when they hit a predetermined price. This limits your losses during market downturns. Regularly reviewing and adjusting your risk management strategies ensures you stay on track with your long-term financial goals. By embracing risk management, you protect your investments and give yourself the best chance for growth. Number 5. Compound interest investing. Compound interest investing is often referred to as the eighth wonder of the world. It involves earning interest on your initial investment, as well as on the accumulated interest from previous periods. This exponential growth principle works best when you allow your investments to grow over a long period of time, as it significantly magnifies returns. For example, if you invest in a high-yield savings account, the interest you earn gets added to your balance, and the next interest calculation is based on that new, larger amount. By starting early and reinvesting your returns, compound interest can turn small, consistent contributions into substantial wealth over time. The longer your money stays invested, the more it can grow. This strategy is particularly effective for retirement savings or long-term financial goals. Time, patience, and regular contributions are key for maximizing the power of compound interest. Number 6. Buy and hold strategy. The buy and hold strategy is a long-term investment approach where you purchase assets such as stocks or cryptocurrencies and hold them for an extended period, regardless of market fluctuations. This strategy is based on the belief that, over time, markets tend to rise in value. By not reacting to short-term volatility, you avoid making emotional decisions that could result in selling at a loss. The buy and hold strategy rewards patient investors who can weather market downturns and benefit from long-term growth. Historically, many of the world's wealthiest investors, including Warren Buffett, have used this strategy to build substantial portfolios. It's a strategy that aligns with a disciplined, passive investment approach, emphasizing the power of time in the market over trying to time the market. Over time, your investments can compound, creating substantial returns and helping you achieve financial security. Number 7. Tax-efficient investing. Tax-efficient investing is about maximizing your after-tax returns by strategically managing your investments to minimize the amount of tax you pay. One way to do this is by investing in tax-advantaged accounts like IRAs, 401ks, or Roth IRAs, which allow your investments to grow tax-deferred or even tax-free. Additionally, understanding the tax implications of capital gains and income tax rates can help you make smarter decisions. For instance, holding assets for more than a year allows you to benefit from long-term capital gains tax rates, which are lower than short-term rates. Tax loss harvesting, which involves selling investments at a loss to offset gains, is another useful strategy. By being mindful of taxes, you can keep more of your investment returns, allowing them to grow faster over time. A tax-efficient strategy helps ensure that your financial growth isn't significantly hindered by high taxes. Number 8. Rebalancing portfolio. Rebalancing your portfolio is a crucial strategy to maintain the right mix of assets according to your financial goals and risk tolerance. Over time, some of your investments will grow faster than others, causing your asset allocation to shift. Without rebalancing, your portfolio might become too heavily weighted in one area, increasing risk. For instance, if stocks perform well and become a larger portion of your portfolio, you may end up with more risk than intended. Rebalancing involves selling off high-performing assets and buying underperforming ones to restore your original allocation. Doing this periodically, whether quarterly, biannually, or annually, helps maintain a diversified, risk-managed portfolio. Rebalancing also provides an opportunity to reassess your goals and make adjustments as your life situation changes. It's an essential strategy to stay on track and make sure your portfolio remains aligned with your financial objectives. Number 9. Setting financial goals. Setting clear financial goals is the cornerstone of effective investing. By having well-defined goals, you create a roadmap for your investment strategy, making it easier to choose the right assets, set deadlines, and determine how much risk you're willing to take. Whether you're saving for retirement, buying a home, or funding a child's education, having specific, measurable, achievable, relevant, and time-bound, SMART goals helps you stay focused. Without goals, it's easy to get sidetracked by market noise or make impulsive decisions. Regularly revisiting and adjusting your goals ensures they stay relevant as life circumstances change. Goals also provide motivation to keep investing, even when the market becomes volatile. By understanding what you want to achieve and taking actionable steps, you pave the way for financial success. Clear financial goals guide your strategy and help you stay disciplined, even during uncertain times. Number 10. Emergency fund planning. An emergency fund is essential for financial stability. It's a reserve of cash set aside to cover unexpected expenses, such as medical bills, car repairs, or job loss. Having an emergency fund gives you peace of mind, knowing that you won't have to rely on credit cards or loans in times of crisis. Financial experts recommend saving 3 to 6 months' worth of living expenses. This safety net allows you to weather financial storms without derailing your long-term goals. When planning your emergency fund, prioritize liquidity. Your savings should be easily accessible, such as in a high-yield savings account or money market account. Keep it separate from your regular investment accounts to avoid the temptation of using it for non-emergency purposes. Planning for emergencies not only protects you from financial stress, but also ensures that your investment strategy remains intact during difficult times. With these strategies in hand, you're ready to level up your financial game. Let us know which strategy you're going to implement first, and make sure to like, comment, and subscribe for more financial wisdom. Stay tuned to Crypto Finances.